following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
We are back. Let's talk futures. Joining me now, economist extraordinaire, Blu Putnam. Blu, good morning.
Hey, good morning, Jim. Good to be here.
I appreciate you being here. We had maybe a not interesting day yesterday. I don't know. I listened to Chair Powell a couple of times, read the notes, and I don't know what to make of it.
Well, the stock market likes it, so I think he's going to cut rates, June, July. You'll figure it out.
Yeah, the stock market likes it as well as gold. Gold seems to love it also.
Well, gold doesn't do well when rates stay high, so a little lower rates is good for gold. Of course, a lot of central banks are buying gold, so there's more going on with gold than just rates, but gold definitely liked Jay Powell's comments.
Yeah, I think in nominal terms, gold's all-time highs. Maybe not in real terms, but approaching that.
Oh yeah, it's quite up there, and pretty amazing actually, given that Fed funds are above the inflation rate and things like that. But you got buyers out there. It's all that counts.
Yeah. So I'm still pretty interested in this whole PCE core, PCE not core, and how one of them shifted a little bit on the dot plot, the SEP report this week from December. So let's talk about that a little bit.
Yeah, I mean, we got a very, very small shift. I mean, these shifts of 0.1%, 1%, 0.2, I really can't get excited about them. I'm a big figure guy, If they move from 2 to 3, I'm interested, but 2.1 or 3, it's too much of an error. But I think we really have to stay focused on the core PCE going forward, because that is the one the Fed targets. And while there are all these other indicators that I and many other people look at, and we look at them because we're trying to figure out what the Fed might do, but the core PC is their indicator. And it's, if you look at the dot plot, it doesn't get down to 2% for quite a while, like years.
Yeah, I was looking at that. So 2024, it looks like they're thinking 2.3 to 2.4. Is a small little bump there, but really 2.5 to 2.6 for this calendar year, and then maybe down to 2.1 to 2.2 in 2025, and then finally we hit the magic number in 2026.
Yes, and we know that the road downhill on inflation is not particularly smooth. So, but when you're doing forecasts, you do tend to smooth them out. So I understand what they're doing, but my guess is we come down a little faster on core in late 24 and into 25 than they're talking about, and that's just a perception that shelter inflation has peaked. It's a lagged indicator. They don't calculate it well, but it is moving in the lower direction, so it'll help the core.
Yeah, and it's we've heard a lot about this. The last mile is always the hardest, right? It almost seems like we're in the last mile right now, which might take 3 years.
Well, we got that phrase, I think, from the technology of getting your house hooked up with cable TV or fiber optics. But what we do know in inflation is you can make a pretty good case that 2% is going to be nearly impossible. And that's because of globalization. Globalization was a huge positive influence in the 90s and early 2000s, keeping goods prices subdued. And, we're not going in the direction of global. We're going the other way. We may have higher tariffs. We may get protectionism. We've got security concerns, U.S. and China. So that suggests that era of 2% inflation that lasted, 2.5 decades, it might be a little hard to come back. On the other hand, we're economists.
Before you say, we also, hang on one sec. We also have onshoring, right? Supposedly now we're going to onshoring. We're building our own chip plants here in the U.S. and stuff like that.
Well, we're onshoring because we're paying for it. And that's the capital infrastructure thing. We're definitely nearshoring. We now do more trade with Mexico than China. And a lot of the nearshoring with Mexico, for instance, they're building a gargantuan natural gas export facility in Mexico that our U.S. natural gas will get there via pipeline from the Permian Basin, and it won't have to go through the Panama Canal. So there's all kind of nearshoring, but yes, there's some onshoring happening too.
Yeah. So anyway, I cut you off. You were about to say, as an economist.
Oh yeah. Well, I prefer to be a one-handed economist. I never worked for President Truman, wasn't born then, but I think he said that first. But at any rate, the direction of inflation, if you take out shelter, is already below 2%. So if shelter is going to get better, we very well could go down to 2% for a year or two before we find out what the real trend is. And so I'm a little more optimistic than the dot plot about how, that inflation's going to have a pretty good second half and into 2025. I need a little bit of 2025 to get there.
Yeah, we did, today we had existing home sales came in hot. It seems like the housing market is pretty hot still.
Yeah, the existing home sales picking up is actually a pretty good sign for the economy, because that means people are willing to refinance at these higher rates, take out a higher mortgage. But that's people that have jobs. They're getting comfortable.
Yeah. Well, that's a good thing, right?
Yeah, it's a very good thing.
Yeah. Okay. So PCE, this idea of 2% might be old-fashioned, I think, is what you're suggesting. We have a couple of charts up here on the screen also, which might, which are hinting at that as well.
Yeah, I mean, I just can't join the religious fraternity on 2% being the magic number. I understand that interest rate policy is very important to inflation, but it's certainly not the only thing. We look at housing, we look at supply chains, we look at jobs, and the Fed tries to talk about some natural rate of interest that's neutral. Forget that, man. That's an unobservable rate, and we have no idea what it is, and they don't know either. And it probably, if it did exist, it probably moved. So you want to just find a comfortable place to be. So and I think that's what, yeah.
Yeah. When I look at the chart on the right, though, immediately I think this is not consistent with the Taylor rule. We're way out of whack still, Fed funds versus core.
We are out of whack. The Taylor rule would have us cutting rates a little bit. And, the Taylor rule is pretty tricky. It says, you give 50% weight to the jobs market and 50% weight to inflation, and you have a rule-based system of moving rates up and down. It's an interesting metric to look at. I certainly look at it, but I wouldn't run the Fed on it.
Well, it's funny because, the Atlanta Fed has three different versions of this Taylor rule that Atlanta Fed's kind of an innovator. They're out there trying to come up with their own gauges sometimes. And they're calculating a Fed fund should be at the most 4.7 right now.
Yeah, and if you look at that chart on the right, most people would argue that the federal funds rate to be, would be about 1% or 1.5% above well-anchored inflation expectations. Well, what's that? So we look at tips and we look at what's the break-even inflation rate for a 5-year, 10-year, and that takes us, and then you add 1% or so to that, and you got what the Atlanta Fed's suggesting.
Yeah. Okay. Well, that makes sense. So, but we're going to have to wait a while, it seems like. So
Well, I don't know
We'll,
about a while. Jay Powell was basically saying, hey, we got a couple of 1/10, 2/10 hot inflation data, but, we look through the data going down. We're going to look through it. We're going to look through the bumps. So he encouraged the market to think about June. And that's certainly where the CME FedWatch tool has anchored itself. I think 65 to 70% probability of a cut in June.
Well, and he used words like, and I'll quote, it'll be likely be appropriate to begin dialing back policy restraint at some point this year.
Well, the key phrase there is at some point this year. And if you start taking that apart, well, you really don't want to do it in the fourth quarter because that's too tight. That's too close to the election to do the first move. You could do a second or third then, but you don't want to be initiating it. So now we're talking about the third quarter, but yeah, when's the third quarter start? Well, July, August, September. So maybe you do it at the last meeting in June or you do it at the first meeting in July. Doesn't really make any difference, I think, but that's how the market took it.
So let's see what the CME, let's see what the market, this is the CME Fed Funds Fed Watch tool. We got 41 days, 2 hours, 43 minutes, and 9 seconds left to the next meeting. So I look at this probability table, Blue, is the first thing I look at. And, 95.8% chance nothing happening in May. And then a 70% chance something's happening in June. And we get to 3 rate cuts by December.
That's right. That's what it says. So, it's zeroing in on June, but it's saying, well, could be the end of July, but mid-June's looking better than that.
Right. And we know this is going to change, of course. But you could compare that to the dot plot, which I'm going to do in a second. Bear with me while I scroll my mouse to find it, because I'm fascinated by the dot plot. Let's get that guy up here. So 2024 is the left column, 2025 is the next column. That's where the focus is. And you could see a consolidation. Remember, in December, we had that dot. Somebody, I don't know if it was Mary Daly or who, was shooting at 3.75 by this year. And that dot's gone.
Yeah, my view on the dot plot is that, 5 or 6 years ago, nobody cared about these things. I mean, we looked at them, but but now, we're focused on them. And so it's the Heisenberg principle. Once you watch something, you change it. And what we're doing in changing the dot plots is we're making it a little harder for the FOMC members to be a near-term outlier. They can still be a far-out outlier. That's okay. But the Fed doesn't like to surprise the markets on the next meeting. And so that's where they need the consistency. 2025, 26, you can do whatever you want. And obviously, there is one way up there.
Well, yeah. And one way down here, right? These two guys are like, okay, we're going to, let's see if I'm right. I'm going to make a wild guess. That's what that tells me.
Well, they have more than a wild guess. They probably have a strong viewpoint. What I've learned in trading is the stronger the viewpoint, the smaller the position you should have. Because if you're sure, that's just too risky.
Yeah. So anyway, it was I don't know what I just did with it. I lost it off my screen. So I spent I don't know how many hours looking at this thing yesterday, Blue, last night. But it was so there's some good information in there. I mean, they talked about the median unemployment rate around 4% this year, 4.1% next year. That to me is full employment.
Oh yes, absolutely.
So that's
the Fed has finally come around to the view that higher interest rates are not going to sink the economy. I mean, if you go back to November 2022, and look at Jay Powell's press conference then, he was saying, we're raising rates. You got to understand there's going to be some pain in the economy. That was higher unemployment. That did not happen. And, it's taken a while, but the Fed now understands that it didn't happen, and they've taken it out of their view.
Well, so is this idea of recession out of the equation? I mean, we're tracking what, a 2.1 on GDP now for first quarter 2024?
Well, the Fed's equate the probability of a recession appears to have declined toward, maybe 25 or 30%. And if you look at these, it's definitely not the base case anymore. That's what's clear. But it's equally, the Fed is looking at things like credit card debt, how much of distressed debt are people, not having a little trouble making payments. They are compared to 6-9 months, a year ago. There, a lot of people are still worried about commercial real estate. So there's, you can go down a list. So you're not going to rule out the recession, but it's no longer anybody's base case, except maybe that one dot way down there.
Yeah, no. Well, speaking of commercial bank credit card plans in the fourth quarter, was 21.5%, according to the Fed. That's the highest in 30 years of available data. And they went on to say, hang on a second, I just lost my cheat sheet. And compares with just the 14.9% in the fourth quarter of 2019, right before the pandemic hits. This is commercial bank credit card plans. So that could be possibly problematic as well when you're tracking an interest rate so high.
Well, that just says people are using their debt a little more. Yes. And that will constrain growth in personal consumption because those interest rates are sky high.
Well, could it also get the commercial banks in trouble with defaults and stuff?
They watch that stuff intraday like a hawk with every kind of pattern recognition software you've got. So I think they're well capitalized. I think they know what's going on. We are seeing some upticks in distressed credit card payments, but they're relatively mild so far.
Okie doke. Well, keep our fingers crossed. Let's talk about quantitative tightening and the balance sheet.
Yes. So this is a chart of the size of the Fed's balance sheet. Back before the Great Recession, it was just a touch less than $1 trillion. And then in the Great Recession, or the financial panic, anyway, when Lehman Brothers and when the Fed engineered the bankruptcy of Lehman Brothers and the bailout of AIG, that was exceedingly messy and badly done. And so the Fed ended up buying $1 trillion worth of distressed assets, not even treasuries or mortgages, that first line up, 2008. They sold all those in 2010 and started buying treasuries and mortgages. And you can see they were pretty aggressive up to 2014 with their QE. Now, that's when the economy was growing. And they were holding rates pretty close to zero. And what that did was give equities and bonds a huge bump up. Turns out it didn't do anything for the economy. And we stayed at a 2.5% real GDP. We stayed at 2% inflation. It didn't work anything like, because the Fed was trying to give the economy a boost, and all they did was give equities and bonds a boost. And then now you look at 2017, 2018, they tried to shrink just a teeny bit. Equities swooned when they started thinking about raising interest rates, just like they did in 2022. No surprise there. Equities are exceedingly interest rate sensitive. And then you got the pandemic. So we went from a $4 trillion balance sheet to $9 trillion, $5 trillion, which also happened to match the approximate increase in federal spending that they gave to the economy. So the Fed neutralized any interest rate impact on the fiscal stimulus that cushioned the pandemic. And then finally, we're, since June of 2023, the Fed's trying to shrink that balance sheet a little bit, and they've knocked $1.5 trillion off.
Well, it's a step in the right direction, maybe. It's still got a long way to go to get back to pre-2008 levels.
I'm pretty sure they have no intention of going back to pre-2008. But Jay Powell proved that he can be exceedingly vague. Because when he was asked about that, he said, well, we're in abundant liquidity right now, and we want to get to ample. And that's all he told us. So I don't know whether ample is 5 trillion or 6 trillion, but I'm pretty sure it's not 1 trillion.
Yeah. So the well, which is interesting because the measure of the goal line here, we don't know. We know where it is with respect to core PCE, but we don't know where it is with respect to the balance sheet.
Yeah, I mean, there's a lot of debate about how large a central bank should be relative to the size of the economy. I mean, the Bank of Japan is like 100%. It's the Bank of Japan's as big as the economy. The Fed's below 30%. Head back toward about 25%. And
how does that compare to like Europe and Great Britain?
I don't know about the Bank of England. The European Central Bank is in the mid-30s. So they're bigger than the Fed, but nowhere near the Bank of Japan. But there's no right answer on this. So, it's definitely a judgment call. And the Fed has started talking about it, but they're not willing to, it's a debate and a discussion. It's definitely not a decision.
Yeah, and I think the language was there's pretty soon we're going to talk about slowing down quantitative tightening.
Yes. So let's go to the next slide. And I think you have a picture of how much quantitative tightening they've done. The picture on the left gives you the 20-year view, and the picture on the right is a little closer. When the bars are going down on the right, that means they're tightening. What you really have to understand is that when the Fed was expanding its balance sheet, it was buying assets very aggressively. When the Fed shrinks its assets, it does not sell. It just lets an asset like a treasury mature, and it makes a decision not to replace it. So QT and QE are not mirror images. QE was very aggressive support of the bond market and therefore the equity market. QT, just letting some stuff run off, is about as benign as you can get. Virtually no real impact, which is what the Fed wants. I mean, if they started selling their longer-term treasuries, I guarantee you we wouldn't sit at 4% very long on the 10-year. But they're not doing that. They're just letting things run off as they mature. By the way, well,
it begs the question: how heavy are they invested in longer term versus shorter term, and how fast is this runoff going to happen?
I think I've got a chart on that. Go to the next chart.
Oh, okay. I didn't mean to jump the shark.
No, it's a great question because you can see on the left, their holdings of Treasury securities have really declined faster than their holdings of mortgages. And the problem in mortgages is what's happening in the housing market. Those people who managed to get a pretty low rate 30-year mortgage over the last 10 or 12 years are not selling their house. And they're not refinancing at 7%. They'd rather have their 3%. And so mortgages are not running off very fast. Mortgages, they're 30 years, but people do prepay much before the 30 years. You generally prepay when you die, when you get divorced, or when you sell your house. And they're not selling their houses as much right now. So treasuries are where they're running off. But if you look at the chart on the right, they're still holding a fairly large percentage, 20 some odd percent of over 10 year. And that's the one that could affect markets. The short-term markets don't care if their T-bill portfolio or their medium-term treasuries run off because the Fed funds target sets that. But the longer end of the yield curve is, got a lot of different factors impacting it. And so the Fed is trying not to do too much, not to intervene much in the long end. So that's what you can tell from these graphs.
Okay, so yeah, that makes a lot of sense. I mean, 1 to 10 years. Okay, we're in this time frame where we're talking 2 years, at least 2, maybe 3 years before the projected core is below 2 anyway, and so some of that stuff will start triggering.
That's right. The Fed during the period of quantitative easing, the Fed really was intervening heavily to manipulate the capital allocation process. If you think about price discovery in equities and bonds, what the Fed was doing during that QE zero rate period was encouraging risk-taking by a huge amount. which is, and then we had to unwind that, and which we did in 2022. That's when rates went up, we had to unwind our risk taking. So equities took a bath that year. But now we're in a different world, and we're in much more neutral territory. The Fed is not manipulating the price discovery process very much. So we're letting the economy do its thing. And I would argue that most policymakers underestimate the resilience of the U.S. economy. It's as long as you don't screw it up, it's going to do pretty well. And that's what we've learned. It handled the increase in rates from 0 to 5. The economy didn't care. The equities did for a year because they're interest rate sensitive. But the economy, not nearly as interest rate sensitive as it used to be.
So that begs the question. Let's assume there's going to be 325 basis point rate hikes between now and December. Will that have, from a historical point of view, would you think that would have a negative drag on the S&P 500 as an example?
No, I mean, as long as interest rates are coming down, the S&P is going to be fine. And okay. The S&P and all these indexes, they're interest rate sensitive when you're going to get a big change in interest rates, or when you're going to get the first change in direction. And Powell has been pretty clear, and I'm with him on this, that the first change is more important. And why is the first change more important? Because it signals they've made a change. The second and third changes are not all that critical once you've decided, because the Fed doesn't like to go back and forth. So it doesn't want to cut and then raise. Greenspan did that once in the late 90s, and he's like, I'm never doing that again if I can avoid it. So they just didn't like that.
Right. So we're last question, Blu, and how is Jay Powell doing in his press conference as compared to Alan Greenspan?
Well, it's a very good question. Jay Powell has embraced forward guidance, particularly as it comes to interest rates. He really doesn't want the next Fed meeting to surprise anybody. Greenspan, particularly back in the early Greenspan went through a couple of phases, but when he took over the Fed in the mid-'80s all the way through the early 90s, he could have cared less if he surprised the markets. And then he started to worry a little more about it and stuff like that. But Bernanke was the Fed chair that really said, okay, forward guidance is a tool. We're going to get better at it. And if you study the Fed funds futures market and how well they predict the future, the Fed funds futures ability to predict the next meeting within 30 days of the next meeting is really good because the Fed's doing better forward guidance than it used to. The Fed funds ability to predict the futures ability to predict the rate 2 years from now, really bad, but that's always been true.
Yeah. Okay. Well, so it's a good, uncertainty is not a good thing. So this is a step in the right direction. Blu, I appreciate you being here with me today. We're going to see you again next week. I'm looking forward to that. And have a great weekend. Thanks for being around.
All right. Thank you. It's great.
All right. We're going to take a really quick break, and Michael Burke, Tom Schneider are going to come in and wrap things up.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.